Okay, this morning I've got around about 1 hour, 1 hour to cover a bit of fringe benefits tax. We're going to look mainly at some of the changes, and I must say every year when I do this presentation I look at last year's slides and think what was there last year, and there's a common theme coming through. The theme is that the tax office are removing more and more concessions out of fringe benefits. They're taxing those benefits that were otherwise exempt, and there's increased audit activity. So after looking at some of those slides in previous years, I thought it'd be a good idea just to have a look at some of the audit activity that you may find, and some of the benefits that have probably evaporated over the last 12 months, and those benefits that are still there that we can utilise for salary packaging or whatnot. So this is a general idea of what we're going to be going through. There are a lot of slides in your pack. We're not going to go through all the slides because we only have around about 1 hour. And it's not A to Z of FBT. I've just cherry-picked some of the items that I think would be useful and relevant, and we'll be going through those. In a nutshell, fringe benefits tax, it's a tax that's payable by the employer. The employer is liable for that tax, and it's for benefits that are provided to staff or associates of staff. Now, one key thing with fringe benefits tax, and generally how you save money, is, as you can see here on the screen, is where there are benefits that are either exempt or concessionally taxed. So I'll give you an example. If someone's on $180,000, if it's an exempt benefit, the exemption means that there's no fringe benefits tax, there's no pay-as-you-go withholding. You can take that benefit, the value of that benefit, and you reduce your gross salary, and then you pay tax on the difference. So ideally, you want to be in the middle column, the exempt benefit column. The next best column to be in is the concessionally taxed benefits, and they're items such as motor vehicle expenses, depending on the type of motor vehicle, depending on the use of the motor vehicle, and there's some other exemptions that are around as well, and we'll talk about some of those. So that's generally how it works. Now, I mentioned that fringe benefits tax is a tax on employers for benefits provided to employees. But I have seen situations that it can also apply where the employer is actually not providing that benefit, and it's called the arranger provisions. And this is how it works. I'll give you an example. A motor dealership, let's call it, and it's not the dealership, Ford. Ford Motor Dealership provided a trip overseas to a dealership out at Bankstown. All the sales guys got to go overseas, and they spent around about $35,000 on that trip. Now that trip itself was not paid by the employer, it was paid by someone else, but the employer facilitated that benefit. They were party to it, they knew it was being provided. As a result, the employer was actually liable for fringe benefits tax, and they received a letter from the head office saying, don't forget to include this in your tax return. So just be mindful of that, because it can also apply where you've got a situation where perhaps staff have been taken out by clients and the employer is party to that. I haven't seen it often recorded in fringe benefits returns where you've got entertainment and lunches, etc., where you've been taken out, but potentially it can apply. Okay, nothing's changed here. The FBT rate, fringe benefits tax rate, so when I mention FBT, fringe benefits tax, is 46.5%. The year end, it's a strange year end, it's 31 March, no change there. It'd be nice to align that with our year end to make it all simple. And then there's various lodgement dates, and you'll find that the lodgement date is looming soon. If you're with next year, you get an extended period of lodgement. So what's new? These are the key rates that I've put in the slides for your benefit. You can see there the benchmark interest rate. That applies where you have a loan to an employee. The benchmark rate is a fringe benefits tax. It's a rate that you use to work out the value of that benefit. So if you don't charge interest, there is a deemed rate for the purposes of working out fringe benefits tax. There's motor vehicles, and we'll talk about that. Car parking, I'll go through an example with car parking and some of the rules with that and some of the concessions that you can actually apply to reduce your tax. Car parking is actually one of those benefits a lot of people forget about and don't realise that they may actually have a tax liability. If you are providing car parking, we'll talk about some of the ways to reduce that dramatically. You'll notice this was a change back a couple of budgets ago about aligning the tax rates for statutory formula purposes. This is where you have a motor vehicle and you use that motor vehicle, principally it's all private use, to work out the taxable value. It was based on how many kilometres the car travelled, This simply states that we're moving into that phase where it's all going to form 20% being the statutory formula. And I'll go through a couple of examples later on. Okay, changes. Changes ahead. Living away from home allowance. Key change. In-house benefits. Another key change. And some government reform ideas. Now, the government reform ideas relates to the not-for-profit sector, and there are a whole array of changes that are proposed on the short-term basis and as a long-term basis. And we'll go through some of those changes for the not-for-profit sector, but I can see this really getting rolled out more and more as the tax office or the government try and tighten the purse strings and claw back some dollars.